Hi, and welcome to another presentation from your business tutor, learning your way, anytime, anywhere. Identifying and then understanding how internal and external factors affect an organisation is absolutely crucial. This is especially the case when a business is making important decisions. Management need to make sure that their decisions are informed and evidence-based, so that the best outcome can be achieved. This is why today's presentation on SWOT analysis is so important. So what are we going to learn in today's presentation? Well, first of all, we're going to find out what a SWOT analysis is. And after that, we're going to find out how a SWOT analysis is created. And then finally, we'll turn to find out why businesses carry out SWOT analysis. The best place to start is to first find out what a SWOT analysis is. Put simply, a SWOT analysis is a decision-making tool used by managers to help them make more informed choices. It does this by initially posing an issue, problem, or question faced by the business. For example, a business may be considering whether to expand or not. After this, the management of a business will identify all the factors that could influence and impact the success of the decision being made. Now, I'm sure many of you will already have made the connection. But this is when identification of relevant internal and external factors comes into play. The business will want to discover all internal strengths and weaknesses that could affect the decision, but also all the external opportunities and threats that could impact on the decision. Draw this all together and you can see where the basis of a SWOT analysis comes from. Strengths and weaknesses come from internal factors, and opportunities and threats come from external factors, which are identified by undertaking a PEST-EC analysis. Now that we've identified what a SWOT analysis is, it is now important to move on and ask, how is a SWOT analysis created? A SWOT analysis is created by undertaking research. For example, based on customer feedback surveys, increasing sales figures, and independent product reviews, a business may conclude that one of their key strengths is good products. Similarly, by looking at the financial information that it holds, such as its bank account balance, level of retained profits, and its statement of financial position, a business may determine that one of its weaknesses is a lack of finance. Whereas, in terms of external factors, by looking at growth rates, income levels, and fashion trends in different foreign markets, the business may identify that India offers an opportunity as it is experiencing high growth. And finally, by finding out that the UK economy is shrinking and customers have less money to spend, that the recession in the UK is a threat to the business. Putting this all together, along with all the other strengths, weaknesses, opportunities and threats it identifies, and the business will be in a position to create, as can be seen, a SWOT to support its decision making. However, as useful as this is, the real power of a SWOT comes from the analysis of each element and the connections between those elements. For example, one of the opportunities identified from the SWOT was that India is a fast-growing market that likes branded products. This is useful to know, but only really beneficial if the business can take advantage of it. Thankfully, by looking at the business's strengths, we can see that the business has good products, which indicates they might sell well in India. Moreover, when we look at the threat the business faces, we can see that the recession may cause sales to fall in the UK. This again suggests that the business should expand to India in order to maintain and increase sales. However, when we look at the business's weaknesses, we can see that the business lacks finance, which obviously could prevent its expansion into India, as it can't be paid for. So where does that leave us? Well, this is when management come into the equation. It is their role and responsibility to assess and analyse all this information so that a strategy can be devised to move the business forward. And in this instance, you'd expect that the strategy devised would be to overcome the lack of finance by obtaining a bank loan or issuing more shares. This would allow the growth into India to be financed, which would give it a far greater chance of being effective. Now that we've seen how a SWOT is created and how it is used, we should now turn to our final question, which is, why do businesses use SWOT analysis? As you will already have worked out from earlier in this presentation, a SWOT analysis allows a business to identify all the factors which can affect and influence decision making. It looks at all internal and external factors, which therefore gives management a full picture of what is going on in their business environment. This, of course, should allow managers to make better, more informed decisions based on high quality information. Using a SWOT also provides managers with a structured decision-making approach, which ensures they take the time required to assess and analyse all relevant factors. This avoids rash, ill-informed decision-making and may in fact result in more creative solutions being devised. This is because following a structured approach gives management the time to consider all factors and therefore identify opportunities that might otherwise have been missed if it had been rushed. Having great information, in the end, is the true value of SWOT analysis. By collecting that high quality information and then considering how strengths, weaknesses, opportunities and threats affect a business, better strategy can be formulated by the business. However, as useful as SWOT analysis is, there are some important drawbacks. First, a SWOT takes time to prepare, which can slow decision making down, meaning opportunities are missed. Following a structured approach can also stifle creativity, especially if managers just go through the process of creating a SWOT and don't think what the information means and how it will impact on their business. Another issue can occur when managers become over-reliant on SWOT analysis, which prevents managers making decisions in real time. This occurs because they feel they have to use a SWOT before they can decide anything, which means opportunities could be lost. A final issue is a SWOT analysis only supports decision making. It does not tell management what the correct decision is. This they must decide for themselves based on the SWOT analysis prepared. So what did we learn in this presentation? Well, first of all, we found out what a SWOT analysis is. And after that, we then found out how a SWOT analysis is created, before finally looking at why businesses carry out SWOT analysis. There is little doubt that SWOT analysis is an important tool in managers' decision-making arsenal. If used correctly, better decision-making will result. However, as we will find out when we look at the role of the manager later in this series, a SWOT analysis is not a replacement for good management. In fact, put simply, a SWOT analysis is only as effective as the manager using it.